Do you know why most startups fail? I do. I've been doing this for 25 years in healthcare, finance, and cryptocurrency. In today's episode, I'm going to talk about those pitfalls. For every business, be that a mom and pop shop or a startup, cash is the lifeblood. If you run out of cash, the business dies, and there really is no going back after that. It's surprisingly easy to run out of cash. I've seen many startups do this before they realize they can't turn that around. So let's talk about these 3 early stage pitfalls that might be relevant to you right now, then 3 later stage pitfalls that might appear as you try to raise money. Let's begin by looking at what the numbers are: expectations of expenses, outsourcing, and hiring, among others. All right, so let's look at the first one, not knowing what to look at. There are 3 things that you should know: your bank balance, the money coming in, and the money going out. This is not difficult. You don't need anything fancy. You can get this from your bank statements. You don't need bookkeepers or financial software. This is pretty straightforward, but you'd be amazed how many startups and founders I realize that don't do this. Using these 3 numbers, you can calculate some other things. You can look at burn, runway, growth rate, and if your company is default alive. Okay, let's go through these one at a time. Your burn is your money in minus your money out. You can get this from your bank statement. It's just the difference between 2 dates. Let's look at an example. If you have $25K in expenses and 10 in revenue, then your burn is $15K. The $15K is the amount you will burn through from the cash you have in reserve in the form of your bank account money or from your investors. It's the cash you need to take from your bank account to cover the short you have due to expenses being higher than revenue. Also, if your expenses are a little lumpy, you can look at averages. You can take the average expenses to calculate your average burn rate. This is known as average burn rate. You can look at 3 months over time and then calculate that average. So once you know your burn, you can get your runway. This is a look at how long you have before you're running out of cash. And the way you calculate this is you look at your bank balance divided by your average burn, which gives you a number of months. For example, here we have $150K in the bank. We just calculated our burn rate is $15K, so this means we have 10 months before running out of money. Again, super straightforward, but you'd be amazed how many founders don't know these numbers about their own company. Just a point here, the burn may change over time, but this number is for you. This is not a number you use to try to make things look good. This is for you not to lie to yourself. I've often heard, so this month's burn rate was $15K. Let's make it $10K so it looks like we have 15 months of runway left. All you're doing is lying to yourself, but you are going to run out of money on the same day. It's just making you feel better right now. So it's super important to be honest with yourself. You can also look at your growth rate. This is looking at 2 periods of time. Your money in month 2 minus your money in month 1 divided by your money in month 1. So this is looking at the rate at which your company is growing. In this example, we have 10K of revenue in July, 12K of revenue in August. So our growth rate is 20%. A side note for those who weren't the math whiz in school. A constant growth rate is going to give you the J curve for the growth of revenue. If you have a 20% growth rate each month, and that number increases each month, then your expenses are going to go up by that percent. Okay, now the final one is if the company is default alive, or the other side, if it's default dead. So the way to calculate this is, if your expenses are constant and your revenue continues to grow, do you have enough cash to reach profitability? There are several calculators online that you can play with and 3 things you can adjust. Typically, you can adjust revenue, growth rate, and monthly expenses, and it will calculate the capital you will need. In this example, you will need $150 of capital, and it will take you 2 years to become profitable. And so those are the things to know, because if you only have $100K of money in your bank account, you know you have a problem. You now know that you need to increase your revenue growth or find a way to cut expenses, because the goal here is to be at a point where you can find a path to profitability. After all, being profitable gives you freedom. Here's an inside tip. If you don't need to raise money, you appear less desperate. So investors want to give you more money, making it easier to raise money. These are some of the first questions investors ask, and I'm always amazed how many founders don't know the answer. The next thing I hear founders say, okay, I looked at my revenue, I looked at my expenses and all the numbers, and then they kind of forgot about it. But actually, this needs to happen more often. You shouldn't be looking at it every quarter or every month. You should be looking at it every week. And if your runway is getting low and your revenue is not constant, you should be looking at it more often sometimes even daily. When anyone asks, you should know your numbers. The next pitfall is underrepresenting your expenses. If you think back to that calculator, it assumes that your expenses are going to remain constant, and in reality, that's probably unlikely, whereas in most startups, their expenses will ramp up over time. You should understand how that's going to happen. What kind of expenses are going to increase, and by what amount of an increase? For example, expenses that may change over time are undervaluing your own time. In the beginning, when you're doing everything and paying yourself a minimum wage and doing things that don't scale, it can make your customer acquisition costs look lower than they actually are. And so when you begin to hire people, you know that your expenses are going to go up. And so you should be aware that over time, as you begin to hire, those expenses are going to go up. Hiring people is just not about their salary. But for every person you hire, you need to provide them with equipment, desk space, and benefits like health insurance. And so all of these things cost extra money on top of their salary. Depending on location, a rule of thumb, an employee will cost about 25 to 50% more than just their salary. If their salary is $100K, then your fully loaded costs are between $125 and $150K. Again, that's super easy to forget. I'm going to hire an engineer and pay them $100K and not realize the true expense might be $150K. Finally, assuming paid acquisition remains constant is another mistake I see founders and companies make a lot. In the early days of your business, it's easy to find customers who are motivated to use your product. Over time, that becomes harder, so the cost to convert customers is going to go up over time. You should be thinking about what the costs are right now and what those costs might be in the future. Runway is not a fantasy metric. It's not a number to make you feel good or look better than your competitor. It's for you to know the health of your company. Don't ignore these numbers, or don't try to massage these numbers to make you feel better, because at the end of the day, you're still going to run out of money, and that's going to become a shock to you. Okay, outsourcing responsibility. Often, a company will hire a CFO as the finances of the company become more complex. And that's a good idea because it takes responsibility off the CEO. But keep in mind, although the CFO is preparing the books and keeping those numbers, the responsibility for those numbers is everyone, especially the CEO. An external bookkeeper or CFO is not going to know the business like the founder or CEO. Often, a bookkeeper will get hold of the bank statements and they will see money going in and money coming out. And they will do their best to identify what these expenses are, but they're looking at it from a removed position. So it's up to the founders and the CEO to look at these numbers quite often and understand what they are. This is the number one thing I hear from CEOs and founders. The bookkeeper made a mistake, and now our runway is only a few months. What happened is, the bookkeeper sent them the numbers and checked the box. I've done my job, and those numbers were never looked at by the founder or CEO. And now there's not enough time to turn this around to become profitable again, and the company dies. Hiring too quickly is easy to do because it feels like a measure of success. Many founders will ask other business owners, how many employees do you have? And they might say, I have 25 employees. And that founder will think to themselves, well, I only have 10. I must not be as successful as they are. So as discussed, an employee costs more than just their salary, but you should also be conscious that every employee is an investment into the business, and you should be getting that return on the investment. For some employees, that's easy, like a salesperson. If they're not bringing in more revenue than their salary, then you're not getting a good ROI. Then think of a support manager. That's a little harder to measure. As CEO, you need to be looking at every employee and making a decision if each one of those employees are helping to move the company forward into a profitable position. It's easy to fall into the trap that the more people you have, the better you are doing. But the best companies do more with less. The way you should be measuring the company is asking, what is my revenue per employee? The higher that number is, the better you're doing. You're doing more with less. Scaling before you get to product market fit is another dangerous thing that startups fall into easily. At the point you're trying to figure out what the product will do and find product market fit, you should be spending as little as possible. And that will give you a longer runway to product market fit. More employees do not help you reach product market fit. It will not help you get there faster or more efficiently. I often hear founders say, my sales are low, so if I hire more salespeople, my sales will grow. I also hear, if I hire more developers, I'll get to product market fit faster. And that's a bad idea. I've also heard, we'll hire more developers so we can build those additional features, X, Y, and Z. And then more customers will buy our product. But if you have product market fit and your product's still janky, and you don't have any of those fancy features, but your customer's still willing to pay because it's solving a big problem for them, then you can start building on features, and then you can start hiring to do that. This is the one there's no coming back from. The other pitfalls, if you make mistakes, you can probably come back from. If you let your runway get too low, then you're going to have trouble raising funds. You should always assume you'll never raise money again. The previous money you raised will be your last. Your goal is to get to profitability on your first funding amount. I have heard founders say often, "Not a problem. My investors will just give me another $1 million." Seed staged money is to help you get to product market fit. It's the money you can raise just off of an idea. Once you get to Series A funding and beyond, that becomes much harder. You need sustained growth, a solid idea, product market fit. This is why it becomes a lot harder as you go through the growth of your company. And in particular, don't leave it too late, because if your runway is running out, your leverage goes down as you're trying to raise money. So if you have 6 months of runway left and you're thinking about raising money, it can be pretty scary because it can take 3 to 6 months or more to get an investor to agree to even put money in. As your cash balances reduce over those months, you're losing leverage. You want to be thinking about fundraising 12 months before your cash runway ends. If you've reached 6 months and you're unsuccessful at raising money, you don't have much time left to get to profitability and have your company succeed. In conclusion, most companies die because they've run out of money. It's super easy not to run out of money, knowing your cash balance and runway at all times. Understanding how your expenses are going to increase over time. Understanding that a high ratio of revenue per employee is a better metric than a number of employees. And have a plan to get to profitability, because you should assume you will not raise money again to get to profitability. Okay, thank you for watching, and I hope my insights into the finances of startups will help you become more profitable. Don't forget to like and subscribe, and I'll see you in the next video.